Hello there, I'm Joe Hainsworth. Today's video is going to answer the question, what is a syndication? So to get right down to it, a syndication is simply a way for investors to pool capital or resources to purchase a large commercial real estate asset. Many times this is an apartment building. It could also be a warehouse. It could be a retail space. Various other types of commercial real estate could be involved. Many of these assets can be 10 million, 20 million, 30, 40, 50, even $100 million. A lot of investors don't have that sitting around, but they might have a small percentage of it. And so they would pool that capital together and be able to go in with other investors. Well, of course, we have to ask the question, why would they be wanting to purchase a large commercial asset in the first place? One of the biggest reasons is when we compare commercial real estate, commercial assets, to other types of investments such as 401k, IRA, or stocks and bonds, or mutual funds, or things like that. There's something that's called the risk versus return ratio. And what this ratio basically looks at is the amount of possible risk for a certain type of investment against its probability of return. Almost any investment can be plotted against this type of a chart using what we call the Sharpe ratio. The Sharpe ratio was determined by William Sharpe in 1966, and it allows you to look at the risk versus return of almost any investment opportunity available. Well, when we look at commercial real estate versus other types of investments, we find that commercial real estate performs very, very, very well. Many times a commercial asset will return 7%, 8%, 10%, 15%, depending on how much risk an investor wants to take on. It also has traditionally shown to be very manageable in the risk category as well, compared to other types of more common investments such as stocks and bonds and mutual funds. And I think we would both agree that of all of the things that the stock market is, stable and consistent is not one of those things. And that's one of the major benefits of commercial real estate, is that it is consistent and it can be very, very stable from year to year to year, no matter what the stock market is doing. Let's take a minute to just look at the 30,000-foot overview of what a general syndication plan would look like. You normally have two different groups of people who are involved in all the aspects of the syndication. The first group of people are the general partners, or the sponsors or operators. These are the people who have experience with commercial real estate. They have a team put together of various different people, of brokers, lawyers, analysts, all the people who are part of the team to make sure that the day-to-day management of a large commercial asset goes according to plan. Now, the general partners or operator team is responsible for all of the day-to-day operations of that specific piece of commercial real estate. And this means that they will be taking care of anything involving tenant relations and relationships, any vacancy issues, any repairs or any renovations that have been written in as part of the business plan. And for their services, they will receive various different types of fees, as well as share in the back-end appreciation of the asset at the sale of it after the end of the hold period as well. Now, most usually in the purchase of a large commercial asset, there will be a mortgage or a commercial loan that's also used for the purchase of the property. But a bank or lender will generally not loan up to 100% of the value of the property. Usually they will only loan up to 60%, 65%, 70%, 75%, depending on the situation. And so the limited partners or the investors who bring the capital for the syndication would be bringing the additional part that is not covered by the commercial loan, not covered by the mortgage. You might say, what's the benefit to an investor to bring a significant amount of capital for a syndication type of purchase like this? One of the biggest reasons is the return on their capital. When a general partner or operator or sponsor will set up the business plan for a syndication deal, they will build into the underwriting process and business plan a certain amount of percentage that goes back to the investors every year for the entirety of the length of the hold period of the asset. And this means that for the entirety of the hold period, which is usually between 3 and 10 years for a commercial syndication, the investors are going to be getting distribution checks from the cash flow of that commercial asset for the entirety of the hold period. The commercial real estate piece, the asset, should be cash flowing to a significant amount every month to cover all of the expenses. On top of the expenses then, the limited partners would be getting distributions every month or every quarter from that cash flow, which is return on their capital. In addition to the cash flow, there are also other advantages to the investors as well, one of them being tax advantages. See, being a limited partner in a syndication allows that investor then to take part in the depreciation. Now, this depreciation is what we might call a paper loss, and it allows the investor to offset other types of income on their income tax return every year. There's another large benefit to the investors, and that is the appreciation of the commercial asset. Commercial buildings and real estate in general tends to appreciate over time given location and other market circumstances, but it generally will appreciate over time. At the end of the hold period, the sponsor team will often underwrite the deal with a sale or a refinance at the end of the 5 to 7 to 10 years. This appreciation that has taken place since the beginning of the purchase of the asset to now the sale of the asset, this appreciation would also go back to the investors in a final equity adjustment where they would get written a very large check at the end of the hold period for that appreciation. Most of the time, given 2023 and 2024 underwriting numbers, this will often be a double equity multiple, which means that if an investor hypothetically invested $100,000, at the end of the hold period, they would have received their entire $100,000 back, plus an additional $100,000 on top, thus doubling their money over the course of the investment. Another major benefit to the limited partners is the ability for them to be able to use retirement account funds in their initial investment. And what I mean by this is that it is legal for an investor, an individual, to use funds from a retirement account into alternative investments such as commercial real estate syndications. Now, there's a lot of nuance with this, and it has to be structured correctly. Most of the time has to be involving a rollover into a self-directed IRA, and you would need to touch base with your attorney or a good custodian who understands real estate syndications and can structure the account to be able to accomplish what you want to do. But it is possible to use funds from a retirement account for a real estate syndication. And this means that for many investors, this is a game changer in what they have available as far as funds and seeing the return on those funds when they're able to use money from a retirement account. For the general partner, there are numerous benefits as well, including tax advantages, as we already mentioned, as well as numerous fees that they will take as part of the management of the asset and making sure that the business plan is enacted the way they have written it out. Now, of course, this is a very simplified explanation of what is a syndication, and there's so much more that we could get into. We'll save that for another video. But from a very high-level overview, this will give you a basic understanding of what is a syndication and how does it function.